Hey everybody, John Murphy, CSSI. Hope you're doing well. I wanted to take a minute or two and speak to you about inherited property. Coming to you from Costco, I thought I was just going to run in and get my tires rotated, and I've got one bad tire and it really shouldn't be driven on, and now I ended up with 4 new tires, so they're working on it. And I'm trying to be productive. So hey, let's get to the topic of inherited property. Speaking with a couple of owners this week, also with the CPA who's working on a final tax return for a building owner who was deceased. And we're just talking through, depreciable basis, cost segregation, tax savings, lowering the final tax bill for the estate, et cetera. But did you know that when, a building, we're all going to have to deal with dying, obviously, and our states are going to have to file the final tax return. But when you're a building owner, you're typically going to have CPAs, you're going to have tax attorneys, they're going to be crunching through the numbers, putting the whole thing together. A lot of times these estates will file extended tax returns, so they got 6 more months to get all of this stuff done. And normally the tax attorneys and the CPAs aren't necessarily thinking about this. So my message is obviously to them, if you happen to get this and you're a tax attorney and you're working on final tax returns for building owners or CPAs, you should be aware of this. But if you have inherited property, I think we can reach more people that way. If you've inherited property, whether it's residential investment, commercial property, et cetera, maybe it might be self-storage or a mobile home park, you should, before the estate files its final tax return, talk to the attorneys, talk to the CPAs who are working on that final tax statement for the estate. Is there any more depreciable basis in any of the properties that the building owner owned? And they may not know that. I mean, the obvious ones are if they look at the depreciation schedule and it's fully depreciated, well, of course, there's no more depreciable basis. However, we still should be looking at all of those schedules because there might be opportunities for capitalization to expense reversal. We're going to scrutinize it, see if we can find any 5, 7, or 15-year class life property that could be depreciated. These are huge tax savings. I mean, let's just say, for example, if we go through the schedules and we find what we think might be $100,000, $200,000 in depreciable expense that could hit on the final tax return. Well, let's say at a 35% federal tax rate, that's $35,000 in income tax savings that the estate doesn't have to pay out if we find that depreciation, and they don't have to pay recapture tax on this. And that $35,000, by the way, goes to the beneficiaries, to the kids, to the grandkids, to the charities that the owner wanted that money to go to instead of to the IRS. So it's a fantastic strategy. The beneficiaries obviously get a step up in basis in the property. They can do cost segregation as well, just so you know, in case, because they probably have a profitable property that they just inherited, and they're going to owe taxes on that. So why not do a cost segregation study on that inherited property? You absolutely should look at doing that. You're going to want to talk with your own tax advisor to see if this makes sense to do that. But if you have any questions, let me know. This is John Murphy of CSSI. I work all over the country. Just find me on LinkedIn or connect with me at Cost Seg Building. I'm also running a blog at costSegBuilding.com. Happy to help, but have us look at those schedules, see if we can't save the estate some money, and have a fantastic day. I'm going to go pick up my car with brand new tires. See ya.